Hi, welcome everybody. This is Kim. I'm going to be introducing Justin for us. He's going to be hosting our Lunch and Learn today, and it's going to be hopefully a beneficial one that you might have some questions. What we might want to do is if you can hold off until the end of the session, then he could kind of get through that first part of the webinar. But hopefully everything will go smooth. And thank you, Justin, for being here on site. We appreciate it. And you are all set. Take it away.
Thank you, Kim. So hope everybody's doing well here today. So on the screen, I have my contact info. So I just wanted to share that with everybody. If you ever have any questions, and it doesn't necessarily even have to be in regard to the retirement plan, but if you have questions that are about investments in general or any economical questions, you're concerned about something, feel free to shoot me an email or give me a call. I'd be happy to help. So we're going to go ahead and get started here. So like Kim said, my name is Justin Petrus and I am with MGO. So what we are on the 401k, we are considered the investment advisor as well as the administrator. Move that for the Quadax 401k. So today what we're going to do is we are going to talk about something that affects every single one of us, whether we realize it or not. And that's going to be how economic policy can shape our retirement journey. So now when we're thinking about Washington, D.C. and politics and just overall economic policy, it might feel like that's something that's very far removed from everybody's day-to-day lives. But the truth is that every policy decision can have a ripple effect that can have a pretty decent effect on your retirement accounts, all of our monthly expenses, and ultimately our financial security at the end of the day. So my goal here today is to kind of connect the dots between policy and retirement planning, but more importantly, give you some practical steps that you can take to make sure that you stay on track. So we're going to start with the basics here. So economic policy directly affects three major areas of retirement planning. First one's going to be savings power. We're going to have investment returns and then tax obligations. So inflation, obviously, it dictates your buying power. So when inflation's running high, your purchasing power is going to be reduced. And that's something that we've all experienced here within the last few years, and we're still experiencing it to some degree here. So when you're thinking of your retirement savings, you're going to need more saved over time just to maintain the same lifestyle in retirement. So the next piece over there is interest rates and Federal Reserve policy. So that has a pretty large impact on bonds, stocks, mortgage rates, car loan rates, you name it. Anything that you're getting a loan for, and then even the price of goods, because when you're looking at how companies expand their business and pass on those costs to the consumer, higher interest rates means higher prices. And then tax laws. So tax laws set the rules for how much you can contribute to retirement plans, how it grows, and how it's taxed when you actually withdraw your money from your account. So when we talk about economic policy, we're not just talking about government, we're not just talking about politics, but we're actually talking about your wallet. So inflation is often called the silent thief because it gradually steals your purchasing power over time. So let's say, for example, inflation averages 3% per year, and we're buying something here today that costs $100. In 10 years, it would cost about $134. And then it would actually jump up to $243 after 30 years. So this means that your retirement savings needs to stretch that much further just to maintain that same lifestyle. So we've seen this recently, and it doesn't matter, what political party is in charge, because we have seen this from the last two administrations. But policies like tax cuts, deregulation, those are the types of policies that supported growth. But then when you combine them with massive spending that we did because of COVID and other government programs, those are things that that have contributed to the inflationary pressures that we all felt a few years ago and then even now. But to put this into perspective, let's just say if you plan to live on $50,000 a year in retirement, you'll actually need over $120,000 per year 3 decades from now just to keep living the same standard. So this is why your financial plan really needs to include things to protect it from that erosion of inflation, whether that's equities or stock, real estate, different strategies like inflation protected bonds. We just want to make sure that you are prepared for all different areas of economic policy. So next here, we're going to talk about interest rates. So interest rates are a powerful lever that the Fed can use to steer the economy in one direction or another. And that is something that does affect us in a multitude of different ways. So we'll start with rising rates. So rising interest rates mean better returns on savings accounts and new bonds. So when you put money into your savings account, as rates rise, obviously the interest rate that you're getting on your savings account will increase as well. And then new bonds. So if you're out in the market and you're purchasing newly issued bonds, rates going up is great because you're going to get a better return on that loan that you're basically giving to either the government or a company. But on the downside of that, as rates rise, that reduces the value of existing bonds. So if you're a long-term saver and you have a bunch of different bonds, and this also applies to CDs and different treasuries and corporate bonds, but as rates rise, the value of the current bonds that you hold falls. So they do have an inverse relationship. So going to the other side of the coin, falling rates. So if rates are falling, it does make borrowing cheaper. So if you're looking for a mortgage or you're going to buy a car or whatever the case is, falling rates obviously make that cheaper. So it does have a positive effect on stocks because there's more money being moved and more sales. But the downside of the falling rates is it does reduce income for people who hold safer investments like those CDs or treasuries. So for people nearing retirement, higher rates can actually be a really good opportunity to lock in better yields. So for example, I'm just thinking back to my personal wealth clients that need a certain amount of income per year in retirement. And what we're doing is structuring it with CDs right now because we do expect rates to fall, that he can set up a more longer term plan with a guaranteed income stream at that particular interest rate. And then also for other people who are currently retired, it is a balancing act. So while you are getting more income from new bonds, you are also having potential losses on old ones. So we've seen a fairly large shift in interest rates here recently, and I'll kind of go through a little bit of brief history here. But going back to 2017, and this was after many years of basically interest rates being zero since the financial crisis of 2008. The Fed did begin raising rates pretty steadily to come to a more of a normalization phase. But that policy, so that was intended to help the economy to grow stronger. So we had rates go from 0 to about 2.5%. Then in 2019, we saw global growth slowing a little bit. We had trade tensions rising, and we had inflation that was below the Fed's target rate. So the Fed cut rates 3 times. They lowered them from about 2.5% down to 1.75 by year's end. And then, of course, COVID hit in 2020. The Fed, in response to COVID, the Fed cut rates pretty aggressively. So they went from 1.75 back down to essentially 0 in just a matter of a few weeks. And then going back to 2022, we had inflation hitting 40-year highs. And it actually peaked above 9% in the summer of 2022. The Fed began its fastest rate hiking cycle in decades. So by December of 2022, rates have risen from 1/4 point or 0.25% all the way up to 4.5%. So by July of 23, rates actually reached 5.5%, which is the highest that we've actually seen in over 20 years. And then currently what we're seeing here now is the anticipation of rates dropping. The Fed, I feel like, is going to continually reduce rates slowly, but that's to try to balance out slowing growth with still elevated inflation. So these swings just show you how quickly we can have things change based on what we see going on economically. So of all of the economic levers that the Fed has the ability to pull, tax policy is usually the most impactful. So I'm going to go back to 2017 when we had the Tax Cuts and Jobs Act. So what that eventually did, it lowered income tax rates through 2025. It doubled the standard deduction, and then it also capped state and local tax deductions. And this policy has been extended with a new bill that was passed earlier this year. But this shifted the math at how we look at retirement contributions, as well as maybe, possible Roth conversions. So for many, Roth conversions and Roth contributions became much more attractive. So as you're seeing tax rates drop, it may make sense to pay the taxes now at what we would consider historically low rates, rather than risk rates being higher in the future. So tax policy, I would say, when you're having presidential elections and you're having campaigning, tax policy is usually the key part of everybody's platform for the most part. And that's why tax diversification is crucial. So having both pre-tax money, having after-tax money like Roth, and then even like an individual savings account, where like a brokerage account, it gives you a lot of flexibility no matter what tax policy could look like in the future. But it is important to have that diversification, because what it comes down to is we have no idea what tax rates are going to be in the future. They could be significantly different. They could be the same. But another way to put that in perspective now is that if tax rates as well as, or federal tax rates, as well as your individual tax rate, doesn't change from now through the rest of your life, it doesn't matter whether you do pre-tax or Roth, you're going to wind up in the same spot. But I don't think that's going to be the case. And I don't think a lot of other people, I think a lot of other people agree with me on that tax policy is going to change over time. It may not be significantly different, but even shaving off a couple percentage points on tax overall over your lifetime, it really could see a significant change in the overall value of what you're pulling from your retirement accounts. So economic policy is something that doesn't affect everybody equally. So it really does depend on your stage in life. So to break that down into 3 different stages, you're going to have your early career savers. Those are people in their 20s up to 40s. We have your pre-retirees, which are ages 50 to 60, in that range. And then we have people who are currently retired, which is 60, 65 plus. So to start from the beginning here, so the early career savers, luckily people in this category have time on their side. So policy shifts, it's going to affect their wages. It's going to affect their jobs, possibly. It's going to affect long-term returns most. And people in this bucket, it's important to focus on maximizing contributions and potentially adding Roth if you're in a lower tax bracket now. So I know I kind of touched on that earlier, but just for an example, I'll give somebody who is in the early stages of their career and they feel that their income is going to rise significantly in the future. So if they're in their 20s and they think, maybe they're making, $50,000 and they think that their income potential later on in life could be 100, 200 or so on, that might be a good opportunity for those people to take advantage of the Roth contributions to pay a lower rate while they have the opportunity, and then change it to more of a traditional style or pre-tax as they age and as their income increases. The middle bucket of people are the pre-retirees, age 50 to 60. So for these people, policy changes have much more of an immediate effect. Taxes, inflation, interest rates changing, that can overall impact your current strategy. And this, again, is a good time to stress test your plan. So by stress test, look at different scenarios that could happen and see, based on the way that your money's allocated, how it could affect it. And that is something that I can provide for all of you. If you want to reach out to me, I could always go through that with you. And then the last bucket is the people who are currently retired. So obviously this group is most vulnerable because they could be having distributions ongoing, taking money out of their retirement accounts. So obviously that inflation is going to eat away at those incomes. Tax changes, it's directly going to impact what you're withdrawing or in how you're setting that up. So flexibility in a balanced allocation is key for these people in that bucket. So here, let's look at some actual examples so it isn't so theoretical. But I know I touched a little bit earlier on the Tax Cut and Jobs Act of 2017. So lowered individual tax rates for most people, standard deduction was doubled. It capped state and local tax deductions. And for the impact, many people reevaluated their tax deferral versus Roth strategies. So did they want to do traditional? Did they want to do Roth? You could also convert portions of your pre-tax money into Roth if you have money in an IRA. Roth 401k is now becoming more attractive. And that's something that is becoming much more popular recently. And it is something that is available within the Quadax 401k. Deregulation. We saw a lot of deregulation here, which is cutting costs, but it also weakens certain consumer protections. So that's kind of a take the good with the bad. We had the Inflation Reduction Act of 2022, and that policy change was basically the most ambitious climate and energy investment in history. And it also was coupled with healthcare savings and some tax reforms. Oops, excuse me. Then we get to trade and tariff policy. That's something that over the last year or so has been forefront in the news. It created some short-term volatility. Portfolios who had international exposure increased a little bit greater volatility, which is just another argument for increasing the diversification on your investment accounts. You don't want to have all of your eggs in one basket. I know that's the old adage, but in addition to that, you want to make sure that your allocation to stocks is appropriate, but in addition to that, your allocation to domestic and foreign is appropriate for your risk tolerance. Bottom line is these policies, these moves change the when and the how of tax and distribution planning. So maintaining flexibility and planning for multiple different scenarios is key. And that's why one of the things here at MGO, as an investment advisor, we focus on that tax diversification, inflation protection, as well as keeping options open as things arise economically. So how do we plan for an environment where policies can shift every few years? I said it earlier and I'll say it again, flexibility. So diversifying that tax exposure, I would say if you have questions as to where your money should be, whether it's pre-tax or Roth or a taxable account, I can help you with that. So if you to reach out to me, I can give you my opinions on that. There are certain types of securities that you can use within the plan and outside the plan that can help against inflation. So that's going to be stocks. Stocks in general are a great way to protect from inflation. The return rates on stocks tend to outpace inflation pretty considerably. There are different real estate REITs, the real estate investment trust. There are other assets as well that hold up a little bit better during inflation or during inflationary periods. And then staying flexible. So you definitely want to avoid locking yourself into something that is irreversible. There are times and places for annuities and investment options like that. But one of the main downsides of something like that is they're really hard to unravel once you've been placed in them. So for example, with an annuity, you get some good, there are some good results that you can get with annuities, but it is very hard to get out of them. There's heavy sales charges if you want to get out early. They're called CDSC, which is a contingent deferred sales charge. So that can eat away pretty significantly at your principal. So maintaining that flexibility is important so you don't get caught in a situation where you have to pay a 7, 8, maybe 9% penalty. So the goal overall is to create a retirement plan that can adapt to whatever. Sometimes I feel like they are throwing darts at a dartboard when they come to policy decisions. Some of it doesn't make a lot of sense, but overall, you want to make sure that we're prepared for anything that they can do. So here's going to be some action items that you can take now, now over the next couple months. So first thing is staying informed. Make sure you don't overreact to headlines. And this is something that I feel like in the last decade or two, headlines have been sensationalized. They're trying to get your attention, and oftentimes it could be kind of misleading. So just make sure that you stay informed and you read past the headlines. Reviewing your asset allocation, that is very, very important. So when you're thinking of the asset allocation of your 401k, let's say, for example, you are somebody who is in that middle bucket, the pre-retiree, who is maybe in their late 50s, early 60s. They may have set up their investment account 10, 15 years ago, and they thought that they were being moderate. So think of like a 60% stock, 40% bond allocation. if that account wasn't rebalanced back to those goal allocations, that particular person could be significantly more aggressive than they ever thought, because that 60% that they originally had in stock has now grown to 80%, 90%, because the market has been so strong here recently. So that is extremely important. Using market volatility as an opportunity instead of panicking. That's also something that is important. Volatility is going to happen regardless of who's in office, regardless of economic policy, anything like that. We're going to have volatility because the market tends to react emotionally. So we're going to have those swings, but it's very important, especially on the downside, when the market pulls back, is to and to not have your first thought being, okay, I'm going to go to cash, or I'm going to go to something way, way, way more conservative, because that could really delay your retirement, quite frankly. It could really put you behind. Making sure that your risk level is correct and make sure that your asset allocation is appropriate is definitely key. Another thing too that's important, and it falls a little bit outside of retirement planning, but it is affected by economic policy, is make sure that you have your emergency fund. When I say emergency fund, make sure that you have a number of months worth of expenses saved, and saved in something liquid that isn't going to change in value significantly. And what I mean by that is not in stock. It should be in like a savings account or a money market account or something like that. Just in case something were to happen where you need money, you have that opportunity, you have that liquidity without selling stock at a loss to cover your expenses. So like I said, policies are going to change and your plan should evolve with them. So make sure that you're scheduling regular reviews. So with a lot of my plan clients, I do consultations pretty frequently. So I'd be more than happy to meet with everybody, obviously not at once, but if you want to put some time on my calendar to review your plan, I'd be more than happy to take a look at that for you. So to wrap up, economic policy isn't just about politics. So it is something that affects your retirement security, your savings power, and your lifestyle once you get to retirement age. So the good news is, with the right strategies, we don't have to be at the mercy of whoever's in Washington at the time making different policy changes. So staying informed, diversifying your accounts, building in that flexibility, and we can create a retirement plan that can handle any of these policy changes or any different policy environments. So remember, retirement planning is a decades-long process. Policies are going to change, administrations are going to change, but being proactive in your planning is what's going to secure your future. So I appreciate everybody's time today. I'm going to open up the floor for questions here. So if you have any questions, please put it in that Q&A section here, and I will read them and answer them. No questions yet. I was expecting a lot of questions. No. Okay, so opinion on allocating assets to precious metals like gold and silver. So I would say, yes, that is a good idea. But I would also, on the flip side, say, no, it's not a good idea if you plan on putting all of your money in there. So I've gotten that phone call from a couple clients that when things do get tough and we're seeing volatility, they want to put all of their money in gold or all of their money in silver or different precious metals. And I would say allocating a portion of your portfolio to those types of investments, I think, is very, very smart. In our managed account portfolios that we offer, we do have exposure to precious metals. That's something that's been in our portfolios for quite some time, and it's something that I don't ever see going away. It's definitely something that we are going to continue to hold. So how to convert traditional to Roth? That is an MGO. Okay, so when you can, so I'm gonna have to look at inside the plan, it could be possible to convert some of your traditional money to Roth. I need to look on that for this particular plan. But outside of the plan, if you have an IRA and you have a traditional IRA, you can convert that to Roth. And depending on where the account is, the procedure is going to be a little bit different, but I can certainly help you with that. Even if you have an account outside of here, I can kind of give you the steps. But basically, it is just converting that, having that account be moved into a Roth account, and those dollars that you have in there will become taxable this year. So if you have $10,000 in a traditional IRA and you want to convert it to Roth, basically you're going to pay ordinary income tax on those dollars that you're converting from traditional to Roth. So always make sure that you understand that there is going to be a tax bill anytime you do something like that, but it can be done. So talk about more about Roth IRA conversions during a downturn. So I would say not as much of a downturn, but more when tax rates drop. So if, for example, just to make round numbers or easy numbers, let's say you're in a 25% tax bracket, and then all of a sudden we have tax policy change and you are now down to, you're in a 15% tax bracket. That is a point where it very well could make a lot of sense to convert those dollars to Roth. So pay the tax at that 15%. And then that is for somebody who thinks that tax rates are going to be higher in the future. So if your tax rate has dropped to 15 and you think later on tax rates are going to go back up to 20, 25%, converting it at 15% is very smart. But of course, no perfect science. We don't know what's going to happen in the future. But for somebody that feels pretty strongly that their tax rate is lower at that point than it's going to be in the future, converting to Roth makes a lot of sense. So this is talking about somebody who purchased certified gold coins at a premium and it wasn't a great investment. So with gold, I wouldn't recommend buying it at a premium. There's a spot price that it's priced daily, basically. So if you go to one of those shops, like a coin shop, maybe not necessarily buying coins. You can buy physical gold. I mean, gold coins are also physical too, but you can buy actual bars of gold. That's a way to do it. You can invest in physical gold. You can't do it in the plan, in the 401k plan, but outside of that, if you have an IRA, there are companies that you can actually buy physical gold for inside of a retirement account, like an IRA. So I would say if that's what you're looking to do is to buy gold for retirement, I would say that's a good place to start. And something I didn't mention when I was talking about gold in our portfolios for managed accounts. So we do have exposure to gold. When you look in the actual funds, a lot of times within the plan or within 401k plans in general, if we're looking at a mutual fund based product, like off the top of my head, there's a fund called Invesco Gold and Special Minerals. That is going to hold some physical gold, but the majority of that portfolio is going to be stock of the gold miners. So another thing to keep in mind is that depending on what investment option you're using, just because it says gold in the name doesn't necessarily mean that it's physical gold. It could be a gold miner stock. Those are some good questions. Okay, well, thank you everybody for joining me here today. I know we're right about 12:30, so I just want to be respectful of everybody's time. So I do appreciate everything. I'm going to put my contact info on the screen one more time. If anybody wants to jot it down. Oh, I think I might got one. So physical gold, silver versus gold, silver back stocks. So that kind of relates to what I was talking about with like the miners. You're getting exposure to that gold or that precious metals sector, not necessarily with the physical gold. But if you're looking for the benefits of physical gold, like protection from inflation, which is kind of what we talked about a lot here. Historically, gold has always been a really good hedge against inflation. Gold has done really well the last few years. I would say if you're looking at the two different areas, I would stick with physical gold. All right, well, thank you very much, and everybody enjoy the rest of your day.